Hi everyone. In Chapter 6, we'll be looking at variable costing and absorption costing, segment reporting, which are tools for management. So we're going to explain how variable costing, which you've already learned, differs from what we call absorption costing, and compute unit product costs under each method. Now, no matter which method you use, you will always include direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, variable selling and administrative expenses, and fixed. It's just where you report them will differ. Direct materials, direct labor, and only variable manufacturing overhead are product costs in variable costing. Fixed manufacturing overhead and both selling and administrative expenses are period costs. When it comes to absorption costing, direct materials, direct labor, and both manufacturing overheads are product costs. And then your selling administrative expenses would be period costs. So which method will produce the highest values for work in process and finished goods inventories? Absorption costing, because it has more costs in it than under variable costing. It has the fixed overhead as well. So let's take a look at an example. Harvey Company produces a single product with the following information. It produces 25,000 units annually. Direct materials, direct labor, and manufacturing overhead, $10 per unit. Selling and administrative variable cost per unit, $3. Fixed cost per year, $150,000. Manufacturing overhead, selling administrative fixed costs, $100,000. So that's the information. To determine unit cost under absorption costing, we would take the variable manufacturing overhead, direct materials, direct labor amount of $10 and add the fixed manufacturing overhead, which would be determined by taking $150,000 divided by the 25,000 units produced for the year. So under absorption costing, your unit product cost would be $16. Under variable, fixed manufacturing overhead is not part of the product cost. So it would only be the direct materials, direct labor, and variable overhead that would be included as the product cost. So you can see if $16 per unit is the amount for absorption costing, inventory would be higher than under variable costing. So all production costs, variable and fixed, are included when determining unit product cost for absorption costing. Only the variable production costs are included for product costs under variable costing, which is how it gets its name, right? So how would we prepare income statements under variable and absorption costing? Let's take a look. Assume the following additional information for Harvey. 20,000 units were sold during the year at a price of $30 each, and there is no beginning inventory. Under variable costing, the sales would be 20,000 units times $30. We would subtract the variable cost of goods sold, which is 20,000 units times $10 each. Remember, we only include variable manufacturing overhead in determining the variable cost of goods sold. The variable selling and administrative expenses would also be subtracted in a contribution format income statement, because remember, that's sales less variable costs. So we would subtract the 20,000 times $3 for variable selling and administrative expenses. Our contribution margin, therefore, would be $340,000. We'll add the fixed and variable, the fixed manufacturing overhead and the fixed selling administrative expenses. Okay, for a total of $250,000. $340,000 minus $250, net operating income, $90,000. Now remember, this is on a contribution format income statement. Under absorption costing, we would have sales of $600,000 less $20,000 times $16 unit product cost, because we use the variable manufacturing overhead and the fixed manufacturing overhead in absorption costing to determine product costs. So under absorption costing, your gross margin would be $280,000. You would then subtract your selling and administrative expenses, the variable portion, $20,000 times $3 or $60,000, and your fixed portion, $100,000. So net operating income, $120,000. Now, what happens here is that under absorption costing, we are expensing $6 more per unit than we are under variable costing. Now, if we made 25,000 units and sold 20, we would have 5,000 left in inventory. So the fixed manufacturing overhead that's deferred under absorption or under variable costing is $6. I'm sorry, nope, under absorption costing, because it would be included in inventory. So the fixed manufacturing overhead that isn't expensed and would be included in inventory because these units weren't sold is $6 as compared to variable costing, because that is the difference in unit price, or $30,000. So you got to keep that in mind, because now when we reconcile the difference between the two methods, we'll take a look at that. So let's take a look. Here's a comparison of the two methods. Again, under absorption costing, cost of goods sold would be $120,000. Ending inventory would have $30,000 in it. Where under variable costing, that $150,000 would have been expensed as a period cost. So the fixed manufacturing overhead that is included as a unit cost, $120,000 is being expensed because the items were sold. The other $30,000 is sitting as an asset, is all expensed under the variable costing method, because fixed manufacturing overhead is not included in the product cost. It's expensed as a period expense. So you could see how they differ right there. So we can reconcile this difference by saying, okay, variable costing net operating income was $90,000. If they had included, if they had not subtracted all of the fixed manufacturing overhead, like absorption costing. Absorption costing didn't subtract all of the fixed manufacturing overhead. They only subtracted the portion that was on the units that were sold. There are 5,000 units that there's $6 difference in product costs between variable and absorption costing. That's been deferred. So that means, if we add that together, the absorption costing net operating income is $120,000, and that's just showing you how the difference originates. It's because of the way the fixed manufacturing overhead is handled. It's product cost and absorption costing. It's a period cost and variable. So it's subtracted to get the $90,000. If you add that, $30,000 that's still hanging out in inventory, never subtracted. Absorption costing net operating profit is the result. Here's an extended comparison of income data Harvey Company for year 2. So now the number of units produced will be 25,000. They sold 30,000. They started beginning inventory with 5,000. They sell them for $30. Their direct materials, labor, and variable manufacturing overhead is $10. Variable selling and administrative is $3. Manufacturing overhead is $150,000. Selling and administrative expenses are $100 on the fixed side. Under absorption costing, again, we'll have a $16 unit price because we'll take the direct materials, labor, manufacturing overhead, variable manufacturing overhead, plus the fixed manufacturing overhead per unit, which is $6, to get a $16 product cost. We'll take the direct materials, direct labor, and variable manufacturing overhead to get the product cost per unit under variable costing. So to determine the contribution format income statement under variable costing, remember we will take the total sales, 30,000 units were sold, $30 each, 900,000. Variable cost per unit under variable costing, $10. For cost of goods sold, 30,000 times 10 or 300,000. We also subtract in a contribution format income statement the variable selling and administrative expenses. 30,000 times 3 would be 90,000. So our contribution margin is 510,000. Remember, we subtract fixed and fixed after that. Fixed manufacturing overhead, fixed selling and administrative cost to get 250, net operating income 260,000. Under absorption, same deal. Sales 900,000. Cost of goods sold would be the 30,000 times product cost of $16 each, 480,000. Gross margin is 420,000. Subtract your variable selling and administrative expenses and fixed selling and administrative expenses of 190,000. You can see how we get the variable selling and administrative 30,000 units times $3 each. That's given. Net operating income is 230,000. Now, the manufacturing overhead released because now all the inventory items are sold. Remember, we produced 25 last month, sold 20. Or last year, I guess it was, for last period. Last period, produced 25, sold 20. Had 5,000 left. This period produced 25, started with 5, sold 30. So now there's no inventory left. We've actually added as an expense now, though, that $6 extra that we didn't last month. Watch how it all jives out. Now when we reconcile, variable costing net operating income is 260,000. This year we added an additional 30,000 to get our absorption costing net operating income. So when we have inventory, we subtract it from our add it to our variable costing net income to get our absorption costing net operating income. When we sell it off, we're going to add that extra amount into cost of goods sold under absorption costing for this period. For this period under variable costing, we don't have that. We already subtracted that last period. So that's just showing you the reconciliation there to get from variable to absorption costing. So there's our comparison. In the end, how much do we show overall? 350 and 350. So some key insights to remember. The relationship between production and sales. When units produced equals units sold, no change in inventory, the absorption will equal the variable's net operating income. But when units produced are greater than units sold, you're going to have an inventory balance. Your income under absorption will be greater than variable because under variable, you're expensing everything. Under absorption, you're not. Units produced will be less when they're less than units sold. Inventory decreases. This will cause absorption income to be less than variable because you will actually be expensing more, because you're expensing more than you produced because of the inventory decreasing. And we've just illustrated all of those items occurring. So how does cost volume profit analysis get involved here? Well, variable costing categorizes costs as fixed and variable, right? So it's much easier to use this income statement format for CVP analysis. Because absorption costing assigns fixed manufacturing overhead to units, like the $6 fixed manufacturing overhead, a portion of manufacturing overhead resides in inventory when units remain unsold. So the potential result is positive operating income when the number of units sold is less than the break-even point. So variable costing income is only affected by changes in unit sales. It is not affected by the number of units produced. As a general rule, when sales go up, right, net operating income goes up and vice versa because of the way we use variable costing and the expenses included in the product cost. Absorption income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if those units are not sold, because the expenses related to those are not being subtracted. So it almost artificially increases income. So you got to keep that in mind. And we saw that already. Take a look back and think about that. So variable costing correctly identifies the additional variable costs incurred to make one more unit, $10. It also emphasizes the impact of total fixed costs on profits. So that's on the variable costing side. So when you're trying to decide what do we do? Because absorption costing assigns fixed manufacturing overhead costs to units produced, that's $6. It gives the impression that fixed manufacturing overhead is variable, but it isn't. We just came up with that $6 by taking the total amount divided by the total number of units. So the result can actually be inappropriate for pricing decisions and product discontinuation decisions. So some negativities about absorption costing compared to variable. So that's our comparison of absorption to variable. The next part of our chapter deals with what we call segmented income statement that differentiates traceable fixed costs from common fixed costs and how we use it to make decisions. So the first thing we need to understand is what do we mean by a segment? So a segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. So it's up to the manager. Do I want to know information about an individual store? They're a segment. Do I want to know information about different sales territories? Each one is a segment. A service center? Each one's a segment. So it's up to the manager to decide what a segment is within their company and select those segments. Keys to segmented income statements are this. There's two. A contribution format should be used because it separates fixed from variable costs and it enables the calculation of a contribution margin. So that's the first thing that should be done and is key to doing this kind of income statement. A traceable fixed cost should be separated from common fixed costs to enable a calculation of a segment margin. So we need to define some stuff here. What is a traceable cost? Well, this is a fixed cost that arises because of the existence of that segment, and it would disappear if the segment itself disappeared. For instance, The salary of Frito's product manager at PepsiCo is a traceable fixed cost of the Frito's segment. So if they got rid of the Fritos segment, would Pepsi still have that product manager's salary? Probably not. A common fixed costs arise because of the overall operation of the company and would not disappear if you got rid of a segment. So they kind of oversee, or they're costs that affect all of the segments, like the CEO of General Motors, his salary, common fixed costs, because it's a fixed cost of all the divisions of General Motors, not just one segment or one division. So when it comes to fixed costs, we have to try to term them as traceable or common. Now, traceable costs can become common costs, so it's important to realize that traceable fixed costs of one segment may be common fixed costs of another. For example, the landing fee paid to land an airplane at an airport is traceable to the particular flight, but it is not traceable to first class, business class, and economy class passengers. So it's a common to that airplane or that flight passenger-wise, okay, but it's traceable to that airplane. So, it's a hard identification process, and you got to keep that in mind. But for our purposes, let's see how we use these things. First, the segment margin, which is computed by subtracting traceable fixed costs of a segment from its contribution margin, is the best gauge to determine long-running profitability of a segment. So we're not going to put all of the fixed costs on that segment, just the ones that would go away. Okay, and that's what I just said. Nice picture of it. So let's take a look. Levels of segmented statements. Weber has two divisions, computer division, television division. Let's look more closely at the television division's income statement. So right now on the television division, their contribution margin format. So remember, that's sales minus all of your variable costs, then go from there with your fixed costs. Sales, $300,000 minus variable cost of goods sold and other variable costs, give them a contribution margin of $150,000 for the television division. They've separated their fixed traceable fixed costs and subtracted them. So the division margin is $60,000. If you use the contribution margin format, again, take sales minus your variable costs, give you the contribution margin of $150,000, subtract the traceable fixed costs, gives you the division margin of $60,000. Let's take a look at the television and computer. Sales for each are listed, variable costs in total are listed for each division and the overall total. Traceable fixed costs are listed as well and subtracted. So the computer division has a $40,000 margin. Television, $60,000, overall $100,000. So we're showing how it is allocated. Now we still need to subtract common fixed costs. They are not allocated to division. They're actually for both divisions. So remember, these are the costs that would remain whether you get rid of a division or not. And then that would lead to our total net operating income of $75,000. Again, as previously mentioned, fixed costs that are traceable to one segment can become common if the company is divided into smaller segments. So you got to be careful of that. We're going to take a look at that with Weber right now. So we have the television division. Okay, now we're going to break the television division down into regular and big screen, 2 product lines. Now, as we do that, notice we have our sales, our variable costs, contribution margin. But now look at the traceable fixed costs. They're lower. They are lower. Before, I believe they were 90,000. 45,000 is traceable to the regular TV, 35,000 to the big screen. 10,000 of the fixed costs that were traceable before are common costs among the 2 divisions. So as we segment, drill down, and create smaller segments, we will see some of our fixed costs that once were traceable may become common. And that's what that's illustrating here. Overall, still a divisional margin of 60. But this is helping us to see even more information about the television division. And the margin, the product line margin on big screen and regular for decision-making purposes. So once a company prepares a contribution format segmented income statement, it could use those statements to make those decisions and now start using break-even analysis. Let's take a look. So in here, we have a 5% increase in sales to 315,000, and there's how it's broken down. Regular and big screen both increase. The margin increases by $52.50 for the regular screen TVs, and the margin increases by $22.50 for the big screen TVs. So if we increase the sales, just the sales, variable costs remain the same. So the sales per unit. Contribution margin will increase. Traceable fixed costs, it looks like, are remaining the same. But now we're going to add 5,000 more in additional advertising. What effect does this have by increasing the sales and the advertising? The divisional margins amount will increase to 62,500. So all we're demonstrating here is that you can use this to now create some assumptions, changes in sales, increasing advertising, and then determining what would be the result. How would we compute a company-wide and segment break-even point for a company with traceable fixed costs? So we're coming back to our television and computer divisions. Our information is presented between the traceable fixed costs, division margin, the common costs, common fixed costs of 25,000 to get to our net operating income. So this is the information we'll use. The company-wide break-even point is computed by dividing the sum of the company's traceable fixed cost and common fixed cost by the company's overall contribution margin. So if we take the 170,000 plus the 25,000 divided by the contribution ratio, 270 contribution margin divided by sales of 500,000 is 0.54. Break even in sales, 361, 111. Now that gives us the company's total break even in sales. Okay, but that doesn't give us by segment. So now, a business segment's break-even point is computed by dividing the traceable fixed cost by its contribution margin ratio. So we ignore the common costs. Here, the contribution margin for the television division is 150,000, sales 300,000. That gives us a contribution margin ratio of 0.5. Divide that into the traceable fixed costs of 90,000. Break even in sales is $180,000. Same with the computer division. Take the 120 contribution margin divided by the sales of the computer division, 200,000, gives us a 0.6 contribution margin ratio. Divide that into the traceable fixed costs of 80,000 for that division. Sales break even 133, 333. Notice the 25,000 of company-wide common fixed costs are excluded from the segment break-even calculations because the common fixed costs are not traceable to segments and are not influenced by segment level decisions. So it's very important to remember when computing break-even analysis. Now let's take a look at omission of costs. Costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. So what we're talking about here, upstream costs, those before the manufacturing process, research and development, product design, those costs should be included in the segment and assigned in the segment. Downstream, those that happen after manufacturing, marketing them, distributing them, and then providing customer service. Those costs should also be accounted for. These are all part of the cost of the product, the value chain. The inappropriate methods of allocating costs. So segment 1, we can have a failure to trace costs directly. Segment 3, an inappropriate allocation base. So we want to be careful. We don't inappropriately allocate costs among segments. Common costs should not be arbitrarily allocated to segments based on the rationale that someone has to cover the common costs for 2 reasons. This practice may make a profitable business segment appear to be unprofitable. Just the traceable costs keep. Allocating common fixed costs forces managers to be held accountable for costs they cannot control. So, when a manager needs to answer for how they manage their department and create profit, if they are assigned to fixed costs they have no control over, that's just not fair, right? So that's 2 reasons we don't include them as part of this process. So it's a little quick check. Hoagland's Lakeshore, they have a bar and a restaurant. There's their sales, variable cost, contribution margin, traceable fixed costs, and they're broken down by bar and restaurant, and then the common fixed costs. Assume Hoagland's Lakeshore prepared its segmented income statement as shown. How much of the common fixed cost of $200,000 can be avoided by eliminating the bar? Well, none of it. That's why it's a common fixed cost. Suppose square feet is used as the basis for allocating the common fixed cost of $200,000. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant 9,000 square feet? The bar would be allocated 1/10 of the cost, or $20,000. 1,000 square feet over total square feet of 10,000. If Hoagland allocates its common costs to the bar and restaurant, what would be the reported profit of each segment? Okay, so if they can allocate those common costs because of square footage, now, they can't get rid of the rent if they get rid of the bar. Okay, so that 200,000 would be allocated to the restaurant. But since they can allocate part of it, the common costs, to the bar and the restaurant, then subtract it that way. Allocate as much as you can. It is not considered a traceable fixed cost because it doesn't go away if the bar goes away. But it can be allocated because of the square foot. So the bar is actually creating a loss where the restaurant is creating income. Should the bar be eliminated? No. Take a look. The profit was $44,000 before eliminating the bar. If you eliminate the bar, profit drops to $30,000. Remember something. The bar was sucking up a lot of the fixed costs. It was sucking up 14,000 of them, right? Even though it was creating a loss in the business for the bar, overall, it was profitable. So if you eliminate the bar, the contribution margin will no longer be there, or the segment margin, and the common costs would be all go to the restaurant. So you need to remember, just because one division or segment is creating a loss in front of you, you need to look at the effect if you eliminated it overall. Both US GAAP and IFRS requires absorption costing for external reports. Since absorption costing is required, most companies also use it for internal reports rather than incurring the additional cost of maintaining a separate variable cost system. So something to keep in mind. Fixed manufacturing costs must be assigned to products to properly match revenues and expenses, and that's why we are required to use absorption costing. Under variable, fixed manufacturing costs are capacity costs and will be incurred even if nothing is produced. So we really need to understand the difference between variable and absorption costing and how we can reconcile the two. And please keep this in mind about the requirements of absorption costing. Both US GAAP and IFRS require publicly traded companies to include segmented financial data in their annual reports. So companies must report segmented results to shareholders using the same methods that are used for internal segmented reports. This requirement motivates managers to avoid using the contribution approach for internal reporting purposes, because if they did, they would be required to share some sensitive data with the public and then reconcile these reports to properly report to the public. Okay, so we've seen different items in here, starting with looking at in our learning objective 1. I'm going back to, I want to go back to looking at variable costing and how it differs from absorption costing, and how we compute unit product costs under each method. Preparing income statements using both variable and absorption costing. And then, reconciling the difference in incomes between the two. Then we looked at preparing segmented income statements and determining the difference between traceable and common fixed costs. And then we computed company-wide and segment break-even points for a company with traceable fixed costs. And then the last area we looked at is what we're required to do under GAAP. So this concludes our discussion of Chapter 6. Please watch for the practice problems. Post any questions you may have to the discussion board.